to Iron Financial. I'm your lead analyst, and today we are executing a massive high-stakes explainer and stress test on a company that literally acts as the foundational bedrock of the global credit markets. We are talking about Moody's Corporation, ticker MCO. Look, in a market environment right now that is just completely filled with geopolitical tremors, complex inflation data, and constantly shifting interest rate expectations, Moody's 2026 earnings performance is the ultimate bellwether for the broader economy. We're going to strip away all the Wall Street noise, look at the raw data, and see what's really happening. And joining me, as always, is our resident market skeptic.
That's right. And look, everyone on Wall Street wants to talk about structural resilience and unshakable business models. But we are here to cut through the market weakness and find out what is actually holding weight. Are these phenomenal numbers truly solid, or are we looking at a house of cards just waiting for a stiff macroeconomic breeze to blow it all down?
Let's just start with the number that's currently flashing bright red all over my terminal right now. A massive, jaw-dropping 57% surge in Q2 diluted earnings per share, hitting $5.03. Even when you look at the adjusted EPS, it was up 31% to $4.68. Now, I just have to ask the obvious question right out of the gate. Is this explosive earnings growth actually forged in steel? Or is it just a byproduct of market hype, temporary debt issuance spikes, and maybe some opportunistic accounting? You don't just magically bolt on 57% earnings growth in a sustained high-rate environment without something highly unusual happening beneath the surface. I mean, that's tech startup growth, not a legacy financial institution. We absolutely need to see the mechanics behind this.
And that is exactly what we're going to figure out right now in the drill down. We aren't just taking management's top-line victory lap at face value here on Iron Financial. We are going to rip this financial structure apart beam by beam and look at the hard, concrete data driving both the first and second quarters of 2026. We need to see exactly how this growth was engineered, where the actual cash is coming from, and ultimately, whether the foundation can truly support this current market valuation. Section 1, Q1 versus Q2, forged in steel. Let's lay out the foundational top-line numbers right now. I want to see the exact progression from the first quarter to the second quarter. Does this structure actually hold weight as the year progresses? Or are we already seeing the stress fractures forming under the immense pressure of these lofty market expectations? Let's take a look. The top-line acceleration here is undeniable, and honestly, it points to massive structural strength. In Q1, Moody's laid a really solid foundation with $2.08 billion in consolidated revenue, which was up a very respectable 8% year-over-year. At that time, they delivered a very healthy 53.2% adjusted operating margin. But look at what happens when we roll into Q2. The engine didn't just maintain its cruising speed, it completely hit the afterburners. Revenue jumped 15% year-over-year to $2.185 billion, and here is the crazy part. The profitability actually expanded right alongside it. We saw operating margins move from 44.3% in Q1 to 47.9% in Q2. And that adjusted operating margin, it stretched out by 440 basis points year-over-year to hit 55.3%. They are scaling up, and they're doing it with incredible operating leverage. Okay, I'll admit that margin expansion is incredibly impressive on paper. Showing that kind of aggressive cost control while bringing in more cash is great. But here is the critical question we have to ask ourselves. Is this top-line acceleration actually built to last? Or is this just a temporary spike fueled by companies rushing to the market to issue debt before the macroeconomic environment sours completely? We need to pivot away from the high-level summary and dig into the specific business units to see what is actually driving this surge. Let's get right into it with Section 2, MIS, the heavy lifting. This brings us to Moody's Investor Service. Make no mistake, this segment is the absolute load-bearing pillar of the Q2 beat. This is their core ratings business, and the sheer volume of capital flowing through this segment right now is staggering. Let's talk about absolute whiplash, because these transaction data numbers are wild. Look closely at leveraged loans on this table. In Q1, transaction revenue for leveraged loans was down 13%. Fast forward to Q2, and it suddenly surges by 50%. That is a massive, aggressive reversal. Meanwhile, investment grades stayed strong, going from 32% growth in Q1 to 17% in Q2, and high yield hovered consistently around 21 to 23% growth across both quarters. But that leveraged loan rebound, that looks extremely volatile to me. And as we all know, volatility is the enemy of a resilient portfolio. Look, you might call it volatile, but I call it the credit markets finally unfreezing after a period of intense hesitation. Overall, MIS shifted from an 8% revenue growth rate in Q1, generating $1.15 billion, to a massive 25% surge in Q2, hitting $1.26 billion.
Total MIS transaction revenue was up an astonishing 34% in Q2 alone. That's real money. And here is the actual structural driver behind that massive 25% MIS revenue jump. This isn't just companies desperately refinancing old, maturing debt at higher rates. We are seeing major, market-moving jumbo investment-grade bond issuances. But more importantly, we are seeing multi-year funding needs directly tied to AI and data center infrastructure. In Q1 alone, rated issuances surpassed $2 trillion, including over $100 billion in jumbo AI-related financings. Think about it. AI infrastructure requires massive upfront capital expenditures. We're talking land acquisition, highly specialized liquid cooling systems, power grid upgrades, and thousands of ultra-expensive GPUs. Tech giants and infrastructure funds don't just pay cash for all of that. They issue debt, and Moody's is right there to rate every single dollar of it. This is structural, long-term capital formation, not just a short-term economic cycle.
Fine, I will concede that the MIS strength is real for now. Capital markets are incredibly active right now, and AI infrastructure is pulling massive, undeniable funding that needs rating. But let's be totally realistic for a second. Ratings revenue is inherently transactional. It's heavily cyclical by nature. If the debt market suddenly frees up due to an external shock, MIS takes an immediate, brutal hit. I want to pivot the interrogation to the recurring revenue side of the house. Let's look at Moody's Analytics. Does this segment actually provide a stable, concrete floor for this company when the transactional side inevitably dries up?
It absolutely does. Let's turn to Section 3, MA, Fortifying the Balance Sheet. Moody's Analytics, or MA, is the steady, recurring engine that fortifies the entire corporate portfolio. While the MIS segment brings in the massive transaction spikes during market rallies, MA provides the deeply embedded software and data moats that generate reliable cash in absolutely any economic environment. Let's break down the sheer scale of this recurring moat. As of Q2, Moody's Analytics has an annualized recurring revenue, or ARR, of $3.66 billion. This is up from $3.61 billion in Q1, and it is split across three highly durable segments. Decision Solutions is the largest piece of the pie, sitting at $1.62 billion. Research and Insights brings in $1.03 billion, and Data and Information provides another cool $1.00 billion. These are essential, sticky products. Hold on a second. Let's look a lot closer at those numbers before we declare victory. You're touting Emma's as this unstoppable, reoccurring engine, but I'm looking at the Q2 reported revenue for Emma, and it only grew by a meager 4% to $925 million. Meanwhile, you're pointing to an ARR growth of 9%. Why is there such a glaring disconnect there? A 4% reported top-line growth is practically stalling out in the enterprise software space. You know that. Look, that 4% reported number is a classic accounting illusion masking the underlying operational strength. You have to account for their strategic divestitures. Moody's sold off their Emma Learning Solutions business in Q4 of 2025, and they fully anticipated divesting the Emma Regulatory Solutions business in Q2 of 2026. When you strip out those variables and look at organic, constant currency revenue, Emma is actually up 8%. And crucially, recurring revenue represents 99% of total Emma revenue. That 9% ARR growth is the true, accurate measure of their expanding, non-discretionary footprint. And when we drill down into the specific growth engines within M&A, the absolute durability becomes obvious. Decision Solutions ARR is up 10%, but look specifically at KYC, Know Your Customer Compliance Software. That is up an incredible 13% to $478 million. Insurance ARR is up 9% to $723 million. You have to understand, these aren't just nice-to-have discretionary software tools that get cut during a budget squeeze in a recession. These are deeply embedded compliance and risk management moats. Major banks and financial institutions simply cannot operate legally or functionally without them. They pay the subscription fee no matter what the economy is doing. Section 4, the steel frame, capital allocation. Okay, I'll give you that. They have a solid software moat, but I'm still highly skeptical of paper profits and adjusted metrics. I want to shift focus and examine the actual steel frame of this company, their capital allocation and free cash flow. Are they actually generating hard, undeniable cash, or is this more accounting magic? Let's follow the money. Let me lay out the concrete cash generation for you because it is nothing short of staggering. In Q1, free cash flow jumped 26% year over year to a massive $844 million. And by the end of Q2, their year-to-date operating cash flow was up 32% to $1.718 billion. And free cash flow escalated to a whopping $1.532 billion. They aren't just generating top-line revenue on a spreadsheet, they are converting a massive percentage of that revenue directly into cold, hard, liquid free cash. And here is exactly what management is doing with that massive pile of cash. In just the first half of 2026, Moody's aggressively returned $2.5 billion directly to their shareholders. That includes a jaw-dropping $2.2 billion in share repurchases and $365 million in dividends. Wow, okay. $2.2 billion in buybacks in just 6 months? I have to admit, that genuinely silences some of my immediate doubts. You simply do not execute share repurchases of that magnitude unless internal management confidence is sky high and the underlying cash generation is absolutely real. That is a massive flex of financial strength. But, and in these current markets, there is always a but, a strong structure can still entirely collapse if the ground underneath it gives way. I'm taking control here because we need to launch the most critical phase of this stress test. We need to look away from the internal balance sheet and look out at the broader macroeconomic environment. Section 5. Macro Risks. Testing the Armor. It is time to truly test this company's defenses. We need to hammer on the seismic activity, the geopolitical risks, and the external macro pressures that could easily crack Moody's foundation as we head into the back half of 2026. Because the core question we have to answer remains this. What happens to this incredible 25% MIS transactional growth if debt issuance suddenly freezes up? What happens if the Goldilocks scenario they are currently operating in turns into a vicious stagflation nightmare? We absolutely have to acknowledge this because the earnings reports themselves explicitly list some severe, potentially catastrophic headwinds. First, delayed U.S. Fed rate cuts. They're even modeling a scenario with potential rate hikes if conflict extends and heavily spurs inflation. They specifically highlight downside risks from the Middle East conflict, undermining global economic expansion and sustaining high energy prices. Furthermore, they are projecting U.S. high-yield spreads to widen out to around 460 basis points, and the global speculative-grade default rate to hit around 3% by year-end. If we get a higher-for-longer rate environment, combined with rapidly widening spreads, corporate borrowing becomes way too expensive. Issuance cools off immediately, and this incredible growth story could easily become a massive value trap for investors. I hear your macro fears, and honestly, they are very valid concerns. But let me counter with management's own concrete response to those exact headwinds. They aren't flinching. In fact, they upgraded their full-year 2026 guidance. They tightened their adjusted diluted EPS range upward to between $16.50 and $17.00. They confidently maintain their expectation for high single-digit revenue growth and an adjusted operating margin of 52 to 53%. And the ultimate, undeniable signal of internal confidence? They actually raised their target for share repurchases up to $3.0 billion for the year. That tells me they have rigorously stress-tested their own numbers internally and firmly believe their portfolio is resilient enough to absorb those macro shocks. Section 6. The Verdict. Moat or Trap. All right, we've drilled deeply through the Q1 and Q2 top-line growth, the massive MIS transaction surges, the MAR recurring revenue floor, the heavy cash flow generation, and the undeniable macro threats looming on the horizon. It's time to synthesize this dense financial data and deliver our final judgment. For me, the verdict is crystal clear. Moody's is a massive structural moat. Their MIS segment is riding a multi-year wave of AI infrastructure and private credit financing that isn't going away anytime soon. And their Moody's Analytics segment provides a $3.66 billion recurring revenue floor built on indispensable risk and compliance software. When you combine that operating leverage with a 55% adjusted operating margin and $3 billion in buybacks, you are looking at an absolute financial fortress. Look, I respect the raw numbers, and the 57% EPS jump in Q2 is undeniable proof of world-class execution. But I offer a final word of caution to anyone watching. The macro timing matters immensely here. If you are buying at these levels, you are paying for absolute perfection. If high-yield spreads widen faster than expected, or if rate cuts are entirely taken off the table by the Fed, that MIS transaction revenue could dry up just as quickly as it surged. It's a beautifully constructed financial building, for sure, but I'm keeping one eye permanently fixed on the tectonic plates shifting underneath it. And that is exactly why we rigorously stress test the numbers here.
to help you forge a stronger, more resilient portfolio no matter what the market throws at you. So we leave it to you. Will Moody's continue to be the immovable bedrock of the global credit markets, or are we just looking at the absolute peak before the quake? Let us know what you think down in the comments. And if you want to continue cutting through market weakness with hard-hitting, data-heavy debriefs, hit that subscribe button. We'll see you on the next explainer, right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.